Good afternoon, everyone, and welcome to our January webinar. It's Exploring Energy and Powering the Future. My name is Mark Marifian. I'm the head of product at Tortoise, and it's a pleasure to have James Mick, our senior portfolio manager, joining us today. January, I'd say, is always a useful moment to reset and say, well, 2025 wasn't a year where energy led the market, but I think it was an important year from a fundamental standpoint. We saw energy actually hold up in a pretty difficult commodity environment where crude oil prices were off 20%, yet energy equities still finished positive for the year. So I think that tells us something important in and of itself. The market is no longer valuing energy just as a simple levered bet on commodity prices, and I know James has a lot to share in that message today. So quick housekeeping item for Q&A. We'll leave time at the end. Do feel free to submit questions at any point during the presentation, and you can do that through the Q&A box at the bottom of your screen. If you have not joined one of our webinars before, or you're new to Tortoise, welcome. These are our monthly webinars that we like to do. We consider ourselves energy specialists. We have more than 2 decades of experience in the energy sector. Today, we manage $9 billion in assets. And really, we have broad expertise across the energy value chain from the wellhead to the end user. If you go to the next page, you can see our investment solutions. And I'll just quickly go over the different capabilities. We have energy infrastructure, which is where the firm got its start. Today, that's about $7 billion in AUM. We also have electrification infrastructure, and that's really positioned more for the long-term growth. And as we see a grid modernization and AI-derived power demand, we have $1.4 billion there. We have strategies focused in broad energy with about $525 million. And then we also have energy adjacent strategies, which are strategies that benefit or are supported from the broader energy ecosystem. If we go to the next page, we can actually start working through our poll questions, and that's another thing we like to do on each of our different webinars. So if we could go ahead and pull up a few quick poll questions for the audience. And the first one is, what do you see as the biggest upside catalyst for oil prices in 2026? Is it a demand surprise? Is it a supply disruption, potentially geopolitics? Is it OPEC plus showing discipline, not flooding the market? Is it underinvestment catching up? I'd say years-long underinvestment catching up. Or is it maybe something more external, or dollar weakness or easier financial conditions? We can cue that. Okay, looks like a supply disruption. James is kind of leader. It really spread across the board with OPEC, underinvestment, and potentially demand surprises as well. Let's go to the next one. How do you expect the energy sector to perform relative to the S&P 500 in 2026? Do we think the sector underperforms? Is it in line? Does it outperform by less than 10%, or does it really have a big year and outperform by more than 10%? And we have a crowd leaning towards outperforming by some less than 10%, some more, and a few in line as well. And then lastly, or a couple more actually, number 3. Which energy subsector are you most bullish on heading into 2026? Upstream, midstream, refiners, utilities, nuclear, or clean energy? Give everyone a second there. Okay, this is evenly split between midstream and utilities, with nuclear and upstream with some votes as well. And then our last one. And in your view, energy equities in 2026 are primarily a income-focused allocation, a valuation opportunity, allocation, a growth-oriented allocation, or really you're just hedging risk, whether that be inflation or geopolitics. Split across the board again, James. But
Good split.
valuation and income, some with growth, and then the minority is in the hedging allocation. So I think that sets up as one nice last segue for our last slide before I kick it over to James, which is just looking at our different capabilities, our product capabilities. We go to the next page of investment solutions. I think the big change that you'll see on this page is that we're now up to 7 ETFs. If you go to the end of 2024, we had just 2. So I'll highlight quickly just a few. August, we launched our AI infrastructure ETF. That's TCAI. That really focuses on the convergence of energy, data centers, and digital infrastructure. Really all supporting AI infrastructure. We see that with 500,000 today. That fund has grown over to 50 million. So we're seeing nice investor interest there. And then in December, we launched 2 new ETFs. We have the Tortoise MLP ETF, that's TMLP. That's innovative and it's structured as a RIC. So it avoids the corporate tax drag that's embedded in traditional C Corp MLP products. And you're getting exposure to MLPs, again, within the ETF wrapper. And then we also launched the Tortoise Nuclear Renaissance ETF, that's TNUC, and that's focused really across a broad value chain of nuclear, and that's critical as we're seeing nuclear reemerge as a critical source of reliable baseload power, and that's being heightened with all the electricity demand. So really taken together, when you look at the different launches and the evolution of our platform, we're trying to move beyond just single themes. And really towards a more comprehensive suite of energy solutions that investors can access and allocate in long-term and for long-term allocations. So, James, enough of me talking. I know you have some great insights. We'll recap 2025, go through industry activity. You have some featured topics, and then you'll wrap up with portfolio positioning. So, looking forward to your presentation.
Great. Thank you, Mark. And thank you all for joining us. So, Gabby, if you want to flip to our first performance area. So we did this actually by quarter as opposed to the traditional doing it month. We thought that would be a little bit better wrap up. I'm actually not going to spend a lot of time on the quarter numbers. I'm going to focus more on the year to date. So I'll just point out here, S&P 500, 2.7% in the fourth quarter, energy up 1.5. So right in the middle, a little bit above. You can see utilities, though, obviously oddly had a weak quarter. In particular, just given the healthcare, which is more defensive, performed well. So a little bit of a strange quarter. But again, quarterly numbers can be moved around a little bit. If you want to flip to the next slide. So on this one, this gives you the subsector performance. The only thing I would point out here is crude oil at the bottom, down 7.9%. And that's actually a theme that we'll see on the next couple pages as well. So Gabby, if you want to move to the year to date, this is where I wanted to spend the most time. So if you think about the year to date for 2025, I think 2 things really stand out from a macro top-down perspective. So first and foremost, you had tariffs. Obviously, Liberation Day, April 2nd. From that point, the market traded off substantially, obviously rebounded pretty well throughout the rest of the year. And that was really tied into the second component from a macro perspective, and that was the Fed. And what linked those 2 things together was inflation, or the expectation of inflation that came about as a result of the tariffs. So as people were concerned about inflation, the Fed had to digest that and determine whether or not they would be willing to cut rates. Of course, inflation is just one of the mandates of the Fed, the other, the dual mandate being employment. And as employment, I would say it softened. It didn't really weaken per se. It was more soft. That allowed, and I think gave the Fed cover to cut. We had 3 cuts, September, October, and December, 75 basis points in total. And that coupled with the tariffs were, I think, the 2 main drivers of the market from a macro perspective. Now, I would say underlying all that or overlaying all that would be AI, which really served as a catalyst for multiple sectors throughout the entire year. And you can frankly see that here. Communication services, you've got Alphabet is in there, technology clearly, industrials to an extent as well. And then you've got the S&P 500 up roughly 18%. What's interesting is utilities really participated up 16%. I think a big driver of that was the need for power, the recognition of that need for power, and utilities were the primary beneficiary. What's interesting is if you go down, though, towards the middle or towards the bottom, you see energy at 8.7% didn't really participate, frankly, in that AI narrative. In fact, a lot of that 8.7 was driven by refiners, which I'll show you on the next page here in a minute, as well as the big oil companies. So not really the driver from, say, the commodities or anything like that related to how energy performed. And then you've got energy infrastructure there up 4.9%. So not a great performer in a relative sense in terms of where the rest of the market was, coming off of a very strong, really 22, 23, and 24. One last thing that's interesting about this page is that the top communication services technology, that's basically been the exact same for the last 2 years. So not a big change in terms of, we saw that in 23, we saw it in 24, and here we see it again in 25. So Gabby, if you want to go to the next page. So this one will be a little bit more about the energy value chain, as you can see, and I'll point your attention. Mark stole a little bit of my thunder here. I'll point your attention to the bottom, and oil down 20% for the year. A lot of that was driven by the one thing I did not mention that happened during last year and was right around that same time of April 3rd, and that was OPEC coming back and basically saying they were going to bring back curtailed volumes at a faster clip than what was expected. So they were going to bring back 2.2 million barrels a day. That was originally going to be done over 18 months. However, they actually ended up doing that over 6 months. So by the end of September, all 2.2 million barrels a day that were available to come back, and a lot of them were already cheating, so not all those came back, but all 2.2 was theoretically back into the market by the end of September. That clearly had an impact on the oil price, and I'll touch more on oil quite extensively here in a few minutes. The other thing I'd point out, as I mentioned, refiners, a great year. When your input price, crude, goes down the way it did at 20%, that tends to benefit your margins, and that certainly worked well for crude and the refiners. From a big oil perspective, Exxon, Chevron, pretty good years, utilities, as I mentioned. And then finally, you can see the producers at the bottom there, right in between the two commodities. Natural gas was a very volatile year, as is typical, but you can see 1.5% for natural gas, down 20% for the oil price. Producers right there in the middle. I think what's interesting about this page as well, from a correlation perspective, while crude oil was down 20, every other sector except for producers were in the green. And that lack of correlation, lack of beta, I think was pretty important for the sector. And we could touch on that more in a little bit as well. So with that, Mark, that touches on performance for the 2025 period.
Yeah, good dispersion of performance over last year. Thanks for covering that, James. So let's go to our next topic, which is going to be industry activity. Geopolitics start to creep up on us again, and so maybe touch on Venezuela to kick us off here.
Yeah, and I'll tell you, Mark, I did not anticipate talking about Venezuela when I was putting together the material for this at the end of the last year. And then all of a sudden, the Trump administration, they go down with the military, they extract Maduro, take him to New York City. He's going to be he's going to be tried in a court for being the head of a narco-terrorist state. So we'll see how all that plays out. But what I wanted to do was really hit on the oil side of this. And I think the expectation of the decision is, well, how does this impact oil? And if you look at this from a historical perspective, this is the average Venezuelan oil production by year. You can see in 1997, 1998, it peaked at a little over 3 million barrels a day, at least in terms of recent time period. Now, that's right about when Hugo Chavez took over. And then you started to see the socialist regime start to be implemented. And as a result of that, you did see some degradation in terms of the little bit on the infrastructure, but also the money that started going to the social programs as opposed to going into the oil infrastructure. In addition, as you move forward, 2007, that's about the time period when the Chavez regime basically went to the international oil companies that were operating within Venezuela and said that they had to enter into a production sharing arrangement or a joint venture, if you will, with PDVSA, which is the Venezuelan oil company, in like a 60-40 split. And a lot of them, frankly, just left, including Exxon, ConocoPhillips. Exxon actually still believes that they're owed $2 billion. ConocoPhillips believes they're owed $12 billion. So maybe a little bit of a high bar for some of those guys to go back in. Chevron actually stuck it out, by the way. And you could see production was relatively flat for a period of time. Maduro, interestingly, took over in around 2013, and that generally stayed flat until you saw the oil price drop. And because the economy was so dependent on oil and those higher prices, that price drop in 2014 that impacted and really went through 2016 started to take effect and really hinder its ability to reinvest. In addition, you had sanctions that came on during the first Trump administration. You hit a bottoming period in 2020 with COVID, and then you slowly started to rebound from there. Most of that sanctions have been on and off a little bit, but for the most part have been on. What's interesting about that is when you entered the year, Venezuela was producing, or I should say pre-sanction or pre-blockade, they were producing about 1.1 million barrels a day. That dropped to 800,000 barrels a day pretty quickly due to the U.S. blockades. So the result of that is that they had to shut in some production. They also did more in terms of storage. And so where does that leave us? Well, I think where that leaves us from a crude standpoint is this. The idea that you can go back in here and ramp production significantly is really far-fetched. I think what you can do is you can return that 300,000 barrels a day pre-blockade, and that's probably pretty easy. So anticipate you can probably go from the 800 to the 1.1 relatively easy. I've also included this box on the right from Rystad Energy in terms of estimates of what it would take just to hold production flat. Again, 1 million barrels a day, holding production flat, you're talking $53 billion of investment. To reach 2 million barrels a day, to double that, 110 billion. And then if you wanted to get back anywhere close to that 3 million barrels a day, you're looking at almost $185 billion of capital investment. And keep in mind, you still have Delcy Rodriguez, who was Maduro's VP, in charge now. So it's the same regime. You really don't have a lot of change in terms of the protections, in terms of the rule of law, in terms of your investment. You have certain majors who, Darren Woods, the CEO of Exxon on Friday, after the meeting with Trump, said that he didn't think that Venezuela was investable in its current state. So it's going to be very difficult to get the majors and get those groups back in there, the ones who can handle this heavy crude, and really ramp that production. By my guess, I think you're probably looking, I'd say it's probably end of decade before you can get to 1.5. And I'd say if you're trying to sniff 2 or 3 million barrels a day, you're looking at somewhere closer to maybe the middle of next decade, best case. So this is going to be a long putt in order to get that production back up to those levels. Now, all that said, one thing I do think we will see is I think we will see a shift in flows. Most of the Venezuelan exports right now, and they keep about 25% for domestic use, the remaining 75% gets exported. Most of that is currently going to China. That will in turn, I believe, redirect to the US Gulf Coast. The Trump administration has already talked about taking 30 to 50 million barrels that's, call it effectively, been in storage and moving that up to the Gulf Coast. This will have an impact on the US refining industry positively because you'll have more competition for heavy barrels, competition with Canada. But in addition to that, that's going to lower the price of that heavy crude, and that's going to lead to better margins for the refiners. So that's an encouraging sign. I don't think it changes a lot else, but I do think you'll see an initial ramp, maybe back up to that 1.1 million barrels a day, somewhere in there. And then after that, you're going to see a redirection of flows in terms of that heavy crude. So, Mark, that's what I have on Venezuela, which is certainly topical and I wouldn't say came out of nowhere, but was definitely a little bit of a surprise.
Yeah, and it obviously fluid situation, but it does blend into the next topic, which is crude oil inventories. James, I know that's something you love to track as we get the data in. So maybe zoom out for the audience and tell us what you're focused on here.
Yeah, so I mentioned the price of crude dropping, and I mentioned it was due to the fact that OPEC was bringing back 2.2 million barrels per day. They did so in relatively fast fashion in a 6-month time frame, as opposed to 18 months. The expectation based on that was that when we entered the fourth quarter, we would start to see crude inventory builds that would be material because we were oversupplied. So what we're certainly doing is we're tracking this and trying to figure out, well, is that occurring? And if so, by how much? And what I'm showing you here on the slide is U.S. crude oil inventories for 2025. And I've got a couple different lines. So the shaded area gives you the min and the max from 22 to 24. The green line is the 3-year average from 22 to 24. And I tried to strip out as much COVID-related noise as I could. And then finally, the blue line is 2025. And what's interesting about this is if you look at that fourth quarter, not a lot of builds, at least not in the U.S. So we are not seeing that build across our area in terms of the most high frequency, most reliable data that you can achieve and you can obtain. Now, what does that mean? And could we still be seeing builds elsewhere? Yes, I think that we have seen an overproduction. And one area you could look at is you could say, well, maybe that's been refined. Unfortunately or fortunately, no, we're not seeing a build in products. So we don't have anything in gasoline, diesel, jet fuel that's out of the ordinary related to the fourth quarter and what you might have expected. You could, and we have seen a lot of this flow into China. They're filling an SPR, Strategic Petroleum Reserve. And so we do believe a lot of it is flowing into China. One thing about that, though, that's gone. That inventory is not coming back anytime soon. So you can assume that that is effectively like demand in this case. How long that lasts, they have a lot left to fill in terms of 2026 with new storage that they're building. So the expectation is that'll continue. And then finally, where a lot of people have talked about this is they've talked about crude on the water. And crude on the water is an interesting concept. It's difficult to track. It's more expensive than storing on land. So there should be some justification for that. The best justification that we can find is that it would be due to the fact that you've got sanctioned barrels, primarily from, say, Russia, from Iran, or even from Venezuela to an extent before the U.S. had their blockade. That's really what those barrels on the water are. It's hard to say, honestly. We don't have great data on that. And the international data lags by sometimes 2 to 3 months. So you do not have excellent data. But what we can tell you is that we're not seeing it in the U.S. in either crude oil or in product. Now, one last thing about this, we will be watching extensively in the first quarter, because the first quarter of every year tends to be the weakest from a demand perspective. And this is when the expectation is of when those builds will occur. It was supposed to be fourth quarter and first quarter. We didn't see it in the fourth quarter. We'll be watching very closely for the first quarter. Mark?
That's great, James. Good overcap on the crude markets. So let's go to our featured topics. We did this a little bit different this time. In the spirit of kicking off the new year, we asked James to talk about 5 forecasts that he thinks will be impacting the 2026 energy markets. So James, pass it back to you.
Yeah. So what I wanted to say about this too is that I tried to go in. These are not they're not broad. They're very specific niche type items within each component. So I'll kind of walk you through what I mean by that. But let's go to the first one, Gabby. And in traditional format, I'm going to start at number 5 and work my way down. Some of you may have seen the Here Come the Humanoids. This was a 60 Minutes episode that was done in early January. This is a picture of Atlas, which is Boston Dynamics robot. And what I like to think is different about this is that they have incorporated the NVIDIA AI chips into Atlas. And so now what you have is you basically have AI on the move. And this is in my opinion, this is a complete game changer from what you will see as robots become more and more prolific. Now, this is not going to happen right away. My point here is that I believe you will hear more and more about humanoids and the development of this. China, frankly, probably leads the world right now, certainly in magnitude and volume, but Tesla's a big component here. Boston Dynamics, which is owned mostly by Hyundai, also a pretty big component. So we think that this is an area that we'll see growth throughout the year. Okay, on to number 4. Now, what you're going to see on these next 4 is I went into ChatGPT and I said, okay, this is my commentary around this specific topic. Chat, can you create for me a picture that symbolizes what this is? And so I thought this was, it turned out pretty fun. I'll pause here briefly and see if you can come up with my rationale or what this picture represents, and then I'll walk through each one of them. So obviously this one talks about the oil market, but importantly, you can see my safety net down there, OPEC plus spare capacity. And as I mentioned earlier, when OPEC brings back more and more barrels, or as they are bringing back more and more barrels, there is less and less spare capacity. In fact, we're getting to the point where that spare capacity is eroding immensely. You're probably going to have a little bit from Saudi Arabia, you're going to have a little bit from the UAE, and a little bit from Kuwait, and that's probably it. And so what you have here is a barrel of oil that is teetering, sweating, if you will, and you're at risk. You're at risk of supply shocks. You're at risk of geopolitics. You're at risk of just broad storms. So think of this. Let's say that Iran, something happens in the next 6 months. That's 3.5 million barrels a day of production. 2.2 million barrels a day of exports. OPEC would not have the spare capacity to solve that issue if something were to happen. So as they have eroded that spare capacity, that raises the specter of having higher oil prices, and the market will have to start pricing that in at some point. When that occurs, I don't know, but I do believe that it could come to fruition sometime in 2026. So that's forecast number 4. Let's move to the next page. I'll pause here and see if you all can get my reference for natural gas. This one is obviously more favorable to natural gas. My view here is this. From a natural gas perspective, I think that it's been a little bit of a second-class citizen in terms of the view of how this power source is thought about in the broader scheme of energy generation in the U.S. Everything went to renewable. That was going to be the big winner, and we think there's some play there as well. That's my number 2 with our 2 solar panels smiling at us. Nuclear certainly garnered a lot of attention, and I think that continues as well. But I think that this is the year that natural gas starts to take its place, and not as a bridge fuel, but as a key component of the generation stack. It's already 40% of our electricity generation, which, by the way, is the highest by a lot. So I think that, in my view, I think this could be the year that natural gas moves to the forefront, which would be great for midstream, great for broad energy. We think that this is a big play as we look forward. Okay, let's go to number 2. I won't give you a lot of time on this one. This one's pretty easy. Obviously, 2025 was a period where nukes had a great year. You can see it's the proverbial runaway train on the train tracks here of rising power demand. If you can read whatever is left there on the train, I have no idea what ChatGPT was doing. I see the word grid, but that's about the only one that makes any sense at all. But anyway, the point here is that nukes garnered a lot of attention in 25. We think that continues in 26. You've got a couple main components coming. Number 1 would be uprates of existing facilities. That just simply means increasing utilization. And then number 2 would be bringing back mothballed or shut down facilities. There's 3 of them. Those are coming back in various stages, none directly in 26, but the CapEx spend is starting in that time period. And so you'll see a lot of noise around this. In addition, I think that you'll see more and more contracts that are signed related to nukes. We think the natural gas and nuclear are clearly the winners here in AI. And this will be an area that you'll hear more and more about throughout the year. Okay, our last one, number 1. Okay, so this one I thought you're hearing all about this all the time. Affordability. And I think if you look at this from a 2026 midterms in November, I think that this is going to be one of the most important topics at the election polls. And as you think about it, I think the Democrats are certainly trying to make this an issue. The Republicans are responding, trying to make it an issue that they're solving. We've got the share of wallet, if you will, from the individual. What's interesting about this is gasoline is actually pretty cheap right now. And if you look at gasoline relative to, say, I went back and compared this to 1999 on an inflation adjusted basis, it's really only about 30 cents above that inflation adjusted number from 1999. So pretty darn cheap across the US. Electricity is similarly not crazy high, but it is very much geographically dispersed. If you're in the Northeast or in California, you're feeling a lot of pressure on your electricity prices. In addition, there is a perception, maybe true, maybe not, that AI and data centers are driving electricity prices higher. I think that this is an issue that is easily solved. And the reason I say that is because the utility companies can bifurcate the rates if they choose to, charge the large load customers one rate, and frankly, even like subsidize a little bit the consumers or the residential customers on the other side. The Trump administration actually came out this morning and said that they are looking to work with the hyperscalers, which I think by that, what they mean is that the hyperscalers are going to front some of this capital cost and some of the electricity cost as well. And as a result of that, I think you're going to see electricity prices moderate a bit as it relates to those areas where we're seeing high data center demand. The last thing that a hyperscaler wants is to have pushback on data centers due to a higher price of electricity. So I think you're going to see this get rectified in, I wouldn't say short order, but it should get solved. And I think that'll really be a benefit at the polling stations and when people go to vote at the voting booths. So That's my number one topic. I think the forecast, I think you're going to see affordability be a bigger and bigger issue throughout the rest of the year. But I think there's good ways to solve that. I would also just note, if you really wanted to tackle this, housing prices would be your best bet because gasoline and electricity are pretty small shares of the wallet. And in fact, if you look back, as I mentioned, to 99, they're not that different. If you look back to housing in 99 versus now, whew, it's dramatic. So big change there. But anyway, that's our forecast, if you will, our top five for 2026. Mark?
Thanks, James. Great synopsis. We'll look forward to watching these play out as the year progresses. So one more topic, which is just portfolio positioning. That's something we always like to cover at the back end of the calls. James, I'll pass it back to you.
Yeah, no real changes here to speak of, Mark. Pretty consistent. We remain big believers in natural gas infrastructure. You can see that throughout. And then the power infrastructure on the far right, utilities, which clearly we believe are well situated to deal with the rising demand, and in particular as it relates to the AI and data center infrastructure. So really, really strong and not a lot of change in terms of our positioning.
Okay. And then I know we're a bit over time. Did have one question come in, which I do want to address. It's fairly topical which is Iran. So more geopolitical developments there. I guess what are the various circumstances that could play out, James? And love to have you touch on those.
Yeah, it is a pretty big topic because, as I mentioned before, 3.5 million barrels a day of production is one of the bigger OPEC countries after Saudi, after Iraq, actually a little bit ahead of the UAE even. So as you think about that, they are exporting around 2.2. Almost all of that goes to China. If the Trump administration, if something does happen, Israel, et cetera, you could have a serious disruption on your hands here in terms of about 2%, a little bit over 2% of the market on a daily basis. And as I mentioned, that would be incredibly difficult to replace based on where OPEC is producing right now. I don't think they probably could. So the result of that would be a higher crude oil price. So I think that there's some real machinations here that the Trump administration is probably going to go through. I think the last thing they want to do is disrupt the oil price rising or raising the inflation that comes about as a result of that. So I think that you'll see a measured approach. I do think that there will be some responses. Right now, the first thing that I've heard is an opening salvo, if you will, is to maybe impose 25% tariffs on anyone who takes the Iranian crude. What's interesting about that is almost all of it goes to China. So really what you're doing is you're putting extreme pressure on China. And that may or may not work out well, as we've seen in the past, that China does have some levers to pull. So not a panacea here in terms of what you can do. But ultimately, I think that there'll be a solution, hopefully, that comes about as opposed to any type of further attacks.
Great. A couple quick more that came in. James, talk about the correlation to crude and what you're seeing there.
Yeah, so the correlation to crude, as I mentioned, we have seen a decline here below historical levels. I actually ran this number a couple of days ago, and so the correlation to crude oil for the midstream sector is running at about 0.4. What's interesting, though, is the beta is about 0.25, and that makes theoretical sense if you think about from a standpoint of a couple things. Number one, we saw that play out, right? Negative 20%, and midstream was up around 5%. But in addition to that, and this doesn't just apply to midstream, but it applies to really all the energy sectors, lower leverage coming out of COVID. They took care of a lot of their debt issues, higher coverage, better cash flow, free cash flow, and frankly, they're in positions to buy back stock. All of those things portend an issue where the price of crude should be less impactful on a historical basis from what we've seen, but also on a go-forward basis. So I would say post-COVID, that correlation to crude has certainly declined for both midstream, upstream, and even some of the other sectors that aren't as tied. And I think that that's something that continues as a result of those things that I mentioned.
And another one came in on regulatory. Obviously, Trump is pushing, to cut regs as much as possible for natural gas and nuclear. Is that actually making an impact? I guess what are the choke points there?
Yeah, yes and no. I think it definitely is starting to make an impact. I don't think we've seen much yet, mostly because some of that comes from, if you think about nuclear as an example, they've really focused on the amount of time it takes to permit one of these projects. So as an example, it used to take gosh, I think it was like 4 years just to permit one of these projects when you did the environmental assessments. They're trying to get that down. I think it was the one big beautiful bill said that they were trying to limit that to maybe more like a year max. So I think that there's the chance for this to have a big impact on the nuclear side. We haven't really seen it yet because you haven't seen a lot of new projects. On the pipeline side, it's already coming to fruition. That regulatory burden, and in particular on the environmental impact statements, that's already less than what it was. And we've seen companies like Kinder Morgan mention during their quarterly calls that they are seeing a positive impact there. And what was taking, a couple of years is now taking less than 6 months. So that's a real positive. So yes, as the regulatory burden declines, we are seeing that, and that should be a positive impact on the price of your project, the return on your investment because of the speed with which you can get something put in service. So all those things are big positives, and we are seeing that for sure.
Right. One last one that came in, which is more product related, which is just related to the leverage in our closed-end fund. Just as a backdrop, we consolidated our closed-end funds. Several of them merged into TYG at the end of last year. So that is our flagship closed-end fund, and you will find typically we're running leverage levels there between 20 and 25%. And today I believe it's at 22%. So that's been fairly consistent over the last couple of years. That, James, is all I'm seeing related to questions. Want to thank our audience for joining. James, I want to thank you for joining and then all the insights. For those who'd like to dial in, February 10th is our next webinar. So we'll look forward to catching everyone there. And then you can see on the screen is our sales team map. And so please reach out to the team if you want to dive more into depth on anything that we talked about today or maybe didn't cover. So hopefully catch up with you all soon and have a great rest of the afternoon. Thanks, James.
Thank you.